Welcome back to Bottom Line. Let's go back to today's latest economic data. Michael Feroli, chief U.S. economist for JPMorgan, joins us to explain what the numbers mean for the economy. Based on data compiled by Bloomberg, he's one of the most accurate forecasters on the Consumer Price Index, making him a Bloomberg Best Economist. And Michael joins us on the phone from his office here in New York. Michael, welcome back to Bottom Line. Always a pleasure to have you on.
Hi, Mark. Good to be back on.
Michael, we saw consumer confidence unexpectedly decrease this month. Housing prices decreased 5.1% in the first quarter from the same period last year. Are we in a soft patch?
Yeah, I think so. I think it's pretty hard to deny the evidence, which seems to be, continuing to build here. We know we only grew at 1.8% annual rate in the first quarter of the year, and it looks to us like we'll be lucky if we get, somewhat above 2% in the second quarter. So that is definitely below but what I think most people were hoping for at the beginning of the year, and probably below what the economy's long-run potential growth rate is. So I would characterize it definitely as a soft patch.
Michael, what were you looking at the beginning of the year?
We had anticipated that growth would be, well above 3%, just based in part on the extra fiscal stimulus we got at the beginning of the year. As it turns out, we've been disappointed in a number of dimensions. I think prime among those would be the rising gas prices, which really hurt the impact of those tax cuts, and I think it meant that consumer spending translated into a lot less real consumer spending than would have occurred otherwise.
Michael, my colleague Tom Keene, a host of Surveillance Midday, calls today's consumer confidence number a new confidence, not unlike the new normal for the economy. And our economics editor Michael McKee pointed out people not only think things are bad now, they think things will be bad 6 months from now. Talk to me about how the psychology of this plays into future metrics.
Right. I think what's most concerning about this morning's number is what it said about the labor market. As many people have noted, some of the factors holding down the economy in the first part of the year have been partly transitory, including some supply disruptions associated with the Japanese earthquakes. Now, if, however, that translates into a weaker labor market, I think there is a risk that we see something that's a little more reinforcing, and it doesn't prove to be as transitory. So to the extent we saw some concerns there on the labor market this morning, I think that's the thing we have to be most alert to in terms of seeing whether this really is transitory or not.
Yeah, well, Michael, speaking of labor market, the May non-farms payroll report released on Friday. What are you expecting?
We're looking for 175,000 on the headline number, which would certainly be a slowing from the pace we saw in April.
Right.
I think April, there were a few categories which look unsustainably strong, and also since April we've seen the jobless claims numbers move up. So we're looking for something that would be a little slower, but it wouldn't be, I don't think that would be a terrible report if we were to get something like that.
Michael, housing prices declined 4.15% on the quarter, and on a 6-month annualized basis, they were down 14.5%. What are the obstacles to a rebound in prices?
Well, I think you have three things that are holding back house prices. First, distressed sales are about a third of all home sales now, and those generally tend to trade at about a quarter below where the rest of the market trades. So that's one thing. I think the second thing is you probably do still have a lot of impediments to credit availability on mortgage credit. And I think the third thing is that you still have some deflationary psychology out there. Most people expect prices to go down, and if you expect prices to go down, you're probably going to not buy, and that's going to contribute to prices going down. So I think we need to get those three things out of the way before we see, a substantially stronger housing market.
Michael, let's talk about a spillover effect here. What effect do price declines have on the overall economy, especially when we see cities like Cleveland, Dallas, Denver, Minneapolis? They're starting to feel the effects of the deteriorating housing market, and those cities have, for the most part, escaped the housing crisis.
Right. I think there are two main concerns. One is on household balance sheets. Lower housing wealth means lower household wealth and lower consumer spending. So far, that's been offset over the past 9 months or so by higher equity wealth, but that seems to be slowing a little bit here. And then the second concern is what it means for the balance sheets of banks and other financial institutions that hold a lot of mortgages. So I think those are the two avenues through which house prices could potentially hold back growth here.
Michael, we have a minute left. Tonight, if I might switch gears to politics, the House voting on a bill to increase the nation's debt limit. Republicans say don't count on their votes unless there are big cuts in spending. The vote's going to come after the markets are closed. Talk to me about how the markets might react tomorrow if that preliminary bill is rejected.
Well, it's my understanding that almost everyone certainly expects that to be rejected, so I wouldn't expect much of a reaction to something that's widely anticipated. But I think you do raise an interesting point, which is that this is another, as if we didn't have enough things to worry about here, this is something that adds a lot of uncertainty to the outlook. And if we were to have, you know, the really bad outcomes play out and the debt ceiling not get lifted later on in the summer, I mean, I really shudder to think what that could imply for the financial system and for the economy.
Michael Feroli, Chief U.S. Economist, JPMorgan Chase, joining us on the phone. Michael, thanks so much. Appreciate it.
Thanks, Mark.